Morning, everyone. Thank you for your patience. Today we have a list of two companies' results update. Then we'll proceed for sector update on Singapore industrial REITs, and then Tehong will give an IPO update on Cromwell European REIT. So the first one will be on ThaiBev. So ThaiBev has released their earnings last Thursday after market. So what happened during the financial year of 2017 was that the 1 year long mourning period in Thailand. So that was the major contributor to the dampen to the weak consumer spending. So as you can see that beer, non-alcoholic beverages as well as food slowed down. Spirits was supported by a higher sales volume. This was mainly contributed by the higher or a short-term spike in the fourth quarter sales volume due to the increase in excise tax. So with that, we see that revenue was flattish year-on-year basis. And if you look down to all the way down to the bottom line, we see a 4.3% growth for the core PATMI. This core PATMI, we excluded the F&N recognition of fair value gains. And the growth mainly comes from an improvement in gross margins across all segments. And with the increase in excise tax that we have seen in mid-September 2017, ThaiBev has actually adjusted their product prices to cover the higher excise tax. From the management, it doesn't seem that they have expanded their margins as per what they have done historically, where they will increase the they'll take the opportunity of increase in excise tax to expand their margins, where selling prices usually will, the increase in selling prices will be more than the increase in excise tax. So in that sense, we think that the management would further review its pricing strategy in the next coming year to expand its margin, especially for the alcoholic beverages. So while all overall cost trends are stable, so we assume that with management further expands its margin, this should provide support for the coming earnings growth. As for the beer market, we see that the market share declined slightly to 38% of total beer sales in Thailand due to an intense competition. If you look at Thailand's economy overall, we are positive where we are expecting a broader economic recovery to take effect, and thus lifting the on-trade consumption. And official forecast for Thai GDP actually was revised up to 4% from 3.5%, and is expected to accelerate in 2018. So this should provide support to the sales volume for its beverages as well as the food segment. With this, we have upgraded our call to buy with a higher sum of the part derived target price of $1.18 from our previous target price at $1.05. So this was on the back of as we roll over our valuations to FY18, and also take into consideration of the potential earnings from its new revenue stream coming from the Grand Royal Group, where it has acquired 75% stake in it in October. Nonetheless, we also take into account of higher finance costs as the group will take up new loans to fund its acquisition spree. So in October, excluding the acquisition of Grand Royal, it also acquired a restaurant chain. And the next in the pipeline would be the 240 stores of KFC in Thailand. And this should navigate the group closer towards realizing its Vision 2020. And any potential acquisition ahead should act as a catalyst for re-rating. And with that, I would like to pass on the presentation to Guangzi, who will talk about gear.
Thank you, Lin Xin. Next is third quarter results update on Golden Energy and Resources. Our title is Coal Price and Sales are trending up. So we maintain our buy call with unchanged target price of 59 cents. Now let's take a look at the results. So the third quarter, in the third quarter, gear deliver phenomenal growth due to the ramp up of coal production as well as the growth in coal prices. So you can see that in 9 months, the production volume grew by close to 50% and the average selling price grew by close to 30%. So as a result, the revenue in 9 months increased by almost 80%. As for the overhead costs, the sales and distribution and administrative expenses also increased a lot due to the ramp up of production volume, resulted in the increase of freight costs and also the increase in the marketing expenses due to the expansion of in other sales channels. So moving forward, we expect that gear will continue to take advantage of the buoyant coal prices and the increase in the production in next year. As the company already guided that in next year, the expected ramp up of production will be from the current year's 14 million tons to more than 80 million tons. And the acquisition of the BSL mine is not completed and will be expected to complete in fourth quarter, and it will come into production in the first quarter of next year. Next, I will pass on to Richard to talk about Singapore Industrial REITs.
Thank you, Guangzi. Hi everyone, good morning. So we published a report last Friday afternoon on the sector report for industrial REITs. I'll just go through some of the key points that I want to highlight from the report. So first slide is the highlights or summary of the report. We are maintaining our equal weight view on the industrial REIT subsector. Based on JTC data, we see that sector occupancy and the rental index still has not bottomed. They are making new lows. Forward-looking wise, oversupply is abating, and same with last quarter, we believe rents to bottom by the end of next year. Same observation also from last quarter is that occupancy has not picked up despite the higher industrial activity. So we want to see occupancy improve in order to upgrade our sector view. Currently, only REIT has not achieved our target price, and REIT is our top pick. This table is the snapshot of the data from JTC. What you can see is that for rental and occupancy for the all industrial as well as for the individual segments, quarter on quarter and year on year, they are all mainly down. The exceptions is business park here, where rental was up both quarter on quarter and year on year, and again business park for occupancy was better. The only other bright spot is for multi-user factory, where occupancy was also higher quarter on quarter. Other than that, everything else is lower. These are some of the key takeaways from the quarter, from our conversations with the managers and our observations from all the announcements that the REITs make. So firstly, sentiment on the ground is better compared to a year ago, but it's still not. It's still a bit challenging. So mainly we still hear that the managers are saying that they do receive more inquiries, but it still takes time to really materialize into a lease signing, and so they are still actively engaging tenants, and priority is to maintain occupancy, and it's a tenants market now. So it's critical to maintain occupancy so that they can continue receiving their rental income, and that would contribute to the stability of their DPU. In this quarter, we hear feedback is that demand is coming from precision engineering, cybersecurity, software, and biomedical devices. Also, outlook for 2018 is negative reversions still to persist. And so what happened in third quarter this year? Mainly the revisions were skewed to the negative side. It ranged from -21 at AA REIT, that's AIMS AMP Capital, to the best performing was 3.1% for Ascendus REIT. Tenant defaults also likely to impact some of their properties in some of the portfolios. So most at risk is Sabana REIT and Soybuild REIT. So Sabana REIT has got 2 master leases that are currently in arrears, and for Soybuild REIT, there are currently 3 properties which are facing tenancy issue. I'll go into more detail in a later slide on Soybuild REIT. Lastly, our observation is that compared to the earlier part of this year, there's been a lot more capital raising activity in the third quarter of this year. So there was a rights issue by cash that was used to pare down their debt. Mapletree Logistics did private placement and preferential offering to acquire that large warehouse in Hong Kong. Mint Mapletree Industrial Trust did a private placement as well. This was to acquire the platform of data centers in USA. And ESR REIT had issued perpetual securities. This was to fund their sale and lease back of a property with high flux. So our investment action for the sector, we are still equal weight. We have split it into the tailwinds and headwinds. So the tailwinds or positive things for the sector is that next year supply is tapering off, and also we see higher industrial activity. Headwinds wise, as you see later in a slide, occupancy is still lower year on year and quarter on quarter. So we are not seeing higher occupancy despite the higher industrial activity, and also negative reversions are expected to continue into 2018. However, overall we think that rents should bottom by the end of next year. And why we are keeping it equal weight is that we still do not see occupancy improving. So we would like to see occupancy improve in order to upgrade our sector view for industrial REITs. This table here shows the 5 REITs under our coverage. This last close price is the last close price on Thursday last week, and these are our target prices. So you can see we have 1 accumulate, 3 neutral, and 1 reduce. This is our top-down view for the sector on how to position yourself. This slide is exactly the same as the previous quarter. There's no change in the top-down view. That is to maintain exposure to business and science park properties and high-tech, high-specs buildings. Reasons are in these 2 bullet points. This is no change from last quarter. It's exactly the same. Now we move on to the individual industrial REITs under our coverage. So we start with Ascendus. So we have this tagline for it called the stable giant. So operationally, the portfolio occupancy remains high, 92%. That's also higher than the industrial average. And then the WALE is 4.2 years. So they have a diversified portfolio and also a ROFR from the sponsor. That is a pipeline of over $1 billion of business and science park properties in Singapore. Out of the current income, 57% of it is coming from business park and high specs properties in Singapore. Gearing is 33%, and that's lower than the sector median. So they still have the headroom to grow inorganically. Now for Mapletree Industrial Trust. So part of their strategy has been to increase their percentage of high-tech buildings in their portfolio, and that includes data center. So you recall that during the quarter they expanded their investment mandate to include overseas data centers. In this quarter, we downgraded Mapletree Industrial to neutral because our target price was achieved already, and we believe that the catalysts have been priced in. Moreover, currently the price to NAV is already about 1.4 times, and this is more than 2 standard deviations from the historical mean. So in the next slide, I'll show you the chart. But going back to their expansion of the investment strategy, so it's included overseas data centers, and this is kept to 10% of portfolio value. So after they had announced this expansion of investment strategy, they had incorporated a 60-40 JV between themselves and their sponsor, Mapletree Investments Private Limited, and this was to acquire 14 data centers in the USA. So in terms of growth outlook for Mapletree Industrial, inorganic side, they still have a very healthy leverage of only 30%. Is among the lowest among the S-REITs universe. For organic growth wise, they have 2 developments which will be completed in 2018. The first is the AEI of the high-tech building at Kallang. This is a speculative build, so unfortunately still no tenant commitment at the moment except for a childcare center. This building is to be completed in the first quarter next year, and then they have a build to suit for data center that will be in second half of next year. So these are their organic growth pipeline. So this chart shows the price to NAV, the historical price to NAV for Mapletree Industrial ever since IPO till now. So you can see that the current price to NAV is already more than 2 times the standard deviation from the mean. So we do not think that there's much upside left for Mapletree Industrial. Now move on to Capital DC REIT. So it gives you specific exposure to a unique asset class, and that's a data center. Organically, the WALE is long, 9.2 years, and they have less than 10% of their leases expiring within the next 3 years. So this will give you a medium-term visibility on the income stream. Moreover, their gearing is also quite low at 32.1%. This is also lower than the sector average, and so this will give them headroom to grow their portfolio. However, their current price to NAV, which is about almost 1.5 times, we also think that there's not much upside left, and they could also use this opportunity to raise new equity, and that would have the impact of a larger unit base. So also at this juncture, we want to highlight a misconception of comparing Capital DC REIT valuation with the globally listed data center REITs. So what the table here shows, all those in red are data centers listed in the data center REITs listed in the US, and then you have Capital DC here, and then this data center REIT that's listed in Australia. So the set of numbers that I want to bring your attention to is the price to NAV. So you will see that for the US listed REITs here, their price to NAV is a lot higher compared to Capital DC REIT and this Australian peer. So I'll discuss about this in the bullet points here. So we'll start by saying that Capital DC is not comparable with the US listed REITs on a price to NAV basis because of the difference in how they record the data centers on their balance sheet. So for Capital DC, the data centers are recorded as investment properties and they are revalued annually to market value. Whereas for the US data center REITs, they are recorded as a PPE, and so they are held at historical cost and depreciated annually. So they are not revalued to market value. So this, so how that affects the price to NAV is that for NAV, you are dividing by NAV which have been derived based on two different way of recording that asset on the balance sheet. So that's why price to NAV is not comparable between Capital DC REIT and the US listed REITs. So talking about this last bullet point here is that difference in accounting treatment is why the US data center REITs can trade at much higher multiples, and so that's why we say that it's not justified to expect Capital DC REIT to trade upwards and be on par with that high price to NAV. Here is a sample from annual reports. This one on the left is from Equinix. The one on the right is QTS Realty Trust. So you can see that this is where their data center buildings and equipment are all parked in the balance sheet, and then after that is less accumulated depreciation. Now we move on to Cash Logistics Trust. So the main thing that has happened for them, actually there are two things that happened this quarter, is that they had a rights issue, and that was used to repay debt and bring down their gearing from 43% to 35%. So now they are in a much better financial state. Their dispute with Schenker also has been resolved. They will receive a rental top-up, which is to market rate, and so there will be no adverse impact to unit holders. So probably either in fourth quarter or sometime in the next FY, they will get their so-called back pay from the period where they had been collecting the lower rent under protest. The key downside risk left for them is the master lease expiry in 2018. This is coming from CWT Commodity Hub, which accounts for about 27% of their portfolio value. Last on our roundup is Soybuilt Business Space REIT, which is currently facing tenant default woes. So they have multiple tenant defaults. One of the old one was Techniques, which defaulted at 72 Loyang Way. So backfilling of that property remains challenging because they need to secure an anchor tenant from the offshore and marine sector. And as you know, the offshore and marine sector isn't doing too well at the moment. The other one is NK Ingredients. Tenant has defaulted on rent, and Soybuilt REIT has already called on the insurance guarantee. The tenant has not topped up the insurance guarantee, so it's likely that this lease will have to be terminated early, and this would affect their income visibility from the first quarter of next year. The other tenant that has defaulted as well is KTL Offshore. So in addition to being in arrears, the parent company also has been flagged by its independent auditor, doubting the group's ability to continue as a going concern. So going forward, the two downside risks for their portfolio is trying to find a replacement tenant to replace NK Ingredients, and to look out for whether KTL Offshore can maintain their rent payments. This chart shows the industrial average for occupancy on the left and rent on the right. So you see that they are still coming down, and they haven't found a bottom yet. Here is for factory type space. We only focus on multi-user. So you can see on the left, the green line, the blue line, multi-user factory space occupancy seems to be stabilizing, whereas on the right side, rental is still soft and has made a new low. Business park wise, relatively stable compared to the rest of the other property types. You can see that even Q on Q there's improvement in occupancy, and Q on Q improvement in the rental index as well. Warehouse occupancy and rental index are both making new lows. So, okay, sorry for the typo. This should be 3Q at the top of the title bar. What the chart on the right is showing is the supply pipeline. Note that for this first set here, this is not comparable with the remaining years, because this is only what's coming out for fourth quarter of this year, whereas for the other sets of data is showing what's coming out for the full year. But just to talk through some of the numbers, in fourth quarter this year, there'll be about 930,000 square meters of space coming out. That will bring the total new supply in 2017 to about 2.3 million. Next year will be lower, about 1.4 million. So this year 2.3, next year 1.4. However, 1.4 million square meters of space is still, although it's lower than the average new supply for the last 3 years, it's still actually higher than the average demand. As such, rent is expected to continue to moderate in 2018. Here, the chart on the right shows what has the amount of supply that has come out in the first 9 months of this year, and compared with what's expected to come out in the 4th quarter of this year. So the only key points to note is you can see for single user factory, quite a lot of space is coming in the 4th quarter compared to the first 9 months, and that could impact multi-user segment where this new single user factories come out, and then the tenants from the multi-user move into the single user. The other thing is that there's no more new supply of business park space for the remainder of 2017. This shows the percentage growth in supply. So you can see here for 2016 overall, it grew 4.1%, and this year is expected to grow 5.1%. And in the following years, you see that it's tapering off 2.8%, 1.7%, and there on. Now this look at the manufacturing indicators. So strong numbers continue to power ahead. PMI is in expansionary mode. The PMI is on the left and is led by electronics. On the right side, you can see industrial production has been robust. Year-on-year percent growth. Year-on-year growth in percent terms has been in the teens, and even reaching up to more than 20% growth in some of the months. For 2018, we believe that this growth will have to moderate due to the base effect. So overall, this slide just summarizes most of the things that I've been discussing about. So I'll skip this slide. This is a snapshot of the quarterly results across the subsector. We'll talk about the revenue side first. So as usual, revenue growth, significant revenue growth normally comes from inorganic growth, and some organic growth will also contribute to that. So for inorganic growth, that's acquisitions. These were at Ascendus REIT, Mapletree Logistics, Capital DC, Soybuild, and Viva Industrial Trust. Organic growth came from Mapletree Industrial and also Viva Industrial. Lower gross revenue came from conversions and divestments. So there were some master lease conversions at Ames AMP and ESR REIT, and there was one divestment at Cash, which resulted in lower year-on-year revenue. The REITs which had the biggest decline in DPU, that's Cash here and Sabana here. These were mainly due to new units issued following their rights issue. This shows the sector. What's different from our previous quarters is that now we've added in Fraser's Logistics Trust into this table. That's because they have completed 12 months of reporting already, so we have some comparable data point. And something to note here, which is intuitive and it shows up in the numbers as well, is that for the REITs with the lowest gearing, they have the highest interest coverage. Here is just a table from the past quarters. Each table is showing about 3 months prior to the previous one. So the trend that we see is that valuations have been going up and the yield has been compressing for the industrial REIT sector. Same here, we have added Fraser's Logistics Trust into this chart. As not much change, all the larger market capitalized industrial REITs tend to be at the bottom right corner, and the rest of them, the smaller capitalized ones, are at the top left corner. Okay, we'll move on to Te Hong, who will share a bit on the Cromwell European REIT IPO.
Hi, morning guys, Te Hong here. We have the Cromwell EU REIT IPOing on Thursday. So I will talk a little bit about what the REIT is about, and some of you may know 2 months ago they tried to IPO, but then eventually it was called off 2 months ago because of the lack of institutional investor demand. So right now they are back, and what is the difference between now and 2 months ago, what they were offering? So first of all, they in the portfolio 2 months ago, they had close to 20% of the portfolio in retail properties in Poland. So this new IPO is the retail space is totally taken out. So now primarily is office space and industrial space. That is number one. Number two is that previously there were also concerns about the lack of sponsor alignment of interest, because the sponsor interest in the REIT for the original for IPO filing was only about 12%. Now they have ramped that up to close to 30%. And thirdly, there were concerns previously about the property management fees of the old proposal, the fees being higher than that of peers. So right now they have aligned that to close to peers as well. And then lastly, they also gotten into an additional cornerstone investor in Gordon and Celine Tang. You guys may be familiar with them. They are the founders of Singhai Group. So with the corrections of all these seemingly unfavorable terms to the REIT previously, now they are back with this offering of 429 million shares. Offer price is 88.5 cents. So what the portfolio will consist of will be 74 properties, mainly in the office and light industrial space, across 5 European countries, but mainly in Holland, Italy, and France. Portfolio WALE is 5 years. The tenant mix is pretty diversified. They have more than 700 clients. Top 10 clients contribute 44% of total rental revenue. And for the sectors that they are most exposed to will be logistics at 25%, government agencies at 21%, and financial institutions at 11%. Post-IPO, they will have an aggregate leverage of 37%. Cost of debt will be pretty low at 2.1%. 86% of all debt are hedged on fixed rates. So some of the investment merits highlighted in the prospectus will be that firstly, they have a geographically diversified portfolio. Asset class is also a balanced mix with a spread of office and industrial space. And then they also have visible organic growth opportunities. Most of the leases in their buildings, they do have built-in inflation-linked rents. So across all these countries, there are annual adjustments to the rents, which will be based on the individual country's CPI, and the contract terms will vary as well. But generally, the metrics that will determine the amount of inflation that the leases will get will be the country's CPI. And the manager is also targeting growth in occupancies. Right now they're doing 88%. They're targeting to grow to 93% over the next 1 year, over the in FY18. If you compare Cromwell EU REIT to the other three overseas listed, locally listed but overseas portfolio, in the Western countries you have iREIT Global, Capital KBS, which also just listed, and Manulife. But to note is that the other three competitors, they mostly own only office buildings, but for Cromwell it is a mix of office and industrial. If you look at the yield comparison between Cromwell and the other three, Cromwell trades at a slightly higher yield, but that will be in compensation for the fact that most of these other competitors, they own mainly office buildings, and for Cromwell they do have industrial buildings as well, which tend to generate higher yield. So with that composition difference, this extra yield is understandable. And not forgetting the fact that most the other competitors have a portfolio which are in fact 100% freehold land, but for Cromwell it's only 88%. The other 12 are leasehold. So for gearing wise, not too much headroom after IPO, I would say, as well, at 37%. So all in we find this a pretty fair valuation. We are neutral on this listing. So with that, we have come to the end of our webinar. If you have any questions, please do type them in the question box.
Good afternoon, everyone. Before we move on to the Q&A, I would like to just bring your attention to our research official website. As you can see on screen now, is stocksbma.com. This is where we publish our research reports, daily technical pulse, and where you can find archive recording and presentation slides of our webinar. We are happy to announce that now POEMS users are able to use their POEMS account to log into Stocks BNB to access all our research reports and use the community function tool that is showing on your screen now, Talk to our Analyst. So all you need to do is to click on the login button on the top right hand corner and choose POEMS user login, and you will need to key in a nickname when you log in for the first time, which will be used to be displayed when you comment or reply to anything on Stocks BNB page. Do take note also now that that you can also comment on our research reports and post new questions topic on this page if you are a registered user or POEMS account user. So do check out stocksbnb.com now and share it with your friends, family, and clients. If you have any queries, you can drop us an email at research@phillip.com.sg. Thank you. Alternatively, you can also use the QR code scanner on your phone or tablet to access our Stocks PMB page using this QR code that is showing on your screen now. There's a question whether we need a different account from our POEMs to log into Stocks PMB. Now you do not need to, so you can use your POEMs account to log in as shown here. So you log in using your ID and password and choose the first time login, and you click and you type your nickname for display purposes.
Hi, this is Richard speaking. So there's a question on the termination of the talks between Sabana REIT and ESR REIT. So we had a trading buy on the thesis that there's a takeover for Sabana REIT. So obviously now with that termination of discussion, the trading buy is no longer valid.
Hi guys, De Hong here again. We have a question on Cromwell. So the question is, when is the first dividend payout for the REIT? Cromwell will pay on a semi-annual basis, but the first one that will accrue to investors will be for first half calendar year 18, and so that will mean that the first payout will be sometime after the June quarter in 18. So I guess that'll be sometime before September 2018 for the first payout, semi-annual. And another question is for if you were to rank the assets on the potential price upside for these three REITs, Manulife, Keppel, KBS, and Cromwell, which one? How is the ranking like? So I interpret this ranking of the assets with the potential price upside to be stock price upside. We do not have coverage on any of these three, but if I were to rank them according to my liking, it would be Manulife first, and then followed by Keppel, KBS. Manulife is because if you look at the yield, they are having a 7.1%, which is even better than Keppel, KBS. Even though it's trading at a higher price to NAV, so despite the higher price to NAV, it offers a higher yield, and that is that is with the fact that they hold CBD offices as compared to Keppel KBS, which has more suburban offices. And in the latest acquisition for Manulife for the New Jersey office, I think they have demonstrated also that they are able to make accretive acquisitions that was at a yield of yield on cost of close to 5.25% for a freehold CBD office with such proximity to Manhattan. I think that was a very good acquisition, and so I think they have sufficiently demonstrated the ability to make accretive acquisitions. And they also have a lower gearing and lower cost of debt for Manulife.
Hi, there's a question on no signboard IPO. So if you look at no signboard, they only the key revenue generator are coming from 3 restaurants only. But as if you compare to Jumbo, Jumbo has quite a range of brand names, and hence I don't think that is a fair comparison against Jumbo as well. And another consideration that you might need to take into account would be their expansion plan. They have tried to they have tried to venture overseas before, but failed. So I'm not sure how they are going to execute it post IPO. And another thing is that the expansion within Singapore as well, because of the very high concentration risk of on these 3 restaurants, and the highest contributor among these 3 restaurants will be the one from Esplanade. So in that sense, these are the few things that you need to take, you might need to take note of when you look into the no signboard IPO. And I don't think that Jumbo is a fair comparison to no signboard. So since there's no more questions, we shall end our webinar for today. Thank you so much for tuning in. We'll see you again same time next week.